I'm trying to get myself organized so I can qualify for the purchase of my first property. But I'm quite confused because I keep hearing lots and lots of different rumors from different people. Some people are saying that I need to have the perfect credit. Some people saying that I need to save first. Some people are saying, no, I cannot buy because I don't even have a job, or that maybe I do have a job, but I haven't been there long enough. What exactly is it that I need in order to make myself lendable and make the banks truly want to lend me money so that I could finally purchase my first home? Is that the dilemma that you're facing and you're looking for answers? Well, let me tell you, you came to the right channel because we're gonna cover that topic today. Hello everyone, and welcome back to another episode. For those who are tuning in for the first time, this is your channel for real estate education. So first-time home buyers, people who are looking to buy homes, whether with assistance or not, what is it that you need to get yourself together and in order so that people don't reject you or the lenders don't send you away because maybe you're not lendable, right? So what we're gonna do is that we're gonna jump straight into the tablet to talk about 8 efficient tips that you can definitely follow in order to make yourself look irresistible for your lenders. So here we are, and tip number 1, and this is gonna surprise you because most people tend to do things all the way around. They do it upside down. They tend to look at houses first, but that's not the first step that you should do. The very first step that you should do is to get your taxes in order, right? So taxes in order, preferably for the past 2 years. Why? Because the banks need to see how much money you're making. This isn't like, the pre-2008 that you can just simply walk up to a bank and say, hey, I'm making $1 million a year. And they're gonna be like, oh yeah, sure, we'll believe you. Now, it doesn't work that way anymore. They do believe you, but they have to verify that you're in fact telling the truth. So if you're saying that you're making, let's say for example, $50,000 a year, they need to see evidence that you're making, in fact, $50,000 a year. And that's why you do it through your taxes. And that's one, right? So verification. Another reason why you need to get your taxes in order is because the amount of money they're gonna lend you will be based on that tax return. So if your tax return is reporting that you make $50,000 a year, they will lend you money based on this $50,000. And the way they do it is that they will base it on, let's say, 3 times or 4 times your income. So the range that you could be qualifying for could range somewhere between $150,000 to $200,000. Just to give you an estimate, right? Now, the second step is to be aware of your budget. And we just covered that just now. What is your budget? Well, it's this number and this number right here, right? So that means that if you make $50,000, then you can qualify for somewhere between $150,000 to $200,000. If you make $60,000 a year, then you take $60,000, you multiply that by 3, or you multiply that by 4, and that should give you a decent range, an approximation of how much you can actually afford, right? Now, the third step that you do is you're gonna go onto Google and you're gonna search for first time home buyers programs. And depending on the state that you live, you will get multiple links from different websites. But for the most part, what you're gonna do is you're gonna find something that comes from HUD.org, which in essence will lead you to the famous FHA mortgages, right? Those are the mortgages that require you to do only 3 to 5% as a down payment. It's typically created for first-time home buyers, but also it is meant to help people from low income and qualify for that opportunity to be able to afford their primary home. Now that you got this, or that you are aware of this, the next thing you're gonna do is to determine how much money you need, right? So how much do you need, right? And that will depend on the type of mortgages that you qualify. So let's say, for example, if you do qualify for an FHA, and we talked about this before, so we're talking about 3 to 5%. Let's assume that the house that you saw that you like, just for example purposes, cost $100,000. That means that with a 5%, you will only need to put down $5,000. That's not so bad, right? $5,000 for down payment, so down payment. But let's say you don't qualify for an FHA, that's okay, it's not the end of the world. Let's assume you do qualify for a conventional mortgage. And a conventional mortgage can range somewhere between 20 to 25%, which means if we're gonna use the higher end of it, that you will need to put down $25,000 as down payment. So that would give you a sense of how much money you need to set aside, whether it's your savings or maybe you can borrow it from an uncle or sister or brother or your parents, whatever, but at least it gives you an understanding of how much money you need. And in addition to that, you should also consider closing costs. Closing costs are usually 3 to 5% of the purchase price of the house. And that means that it could translate to somewhere to $3,000 to $5,000. So let's say, for example, if you did qualify for an FHA, you will have to add $5,000 to this number, which will translate to $10,000 cash that you will need in order to be able to afford that property. If you qualify for a conventional, a traditional mortgage, what you're going to do is you're going to add the $5,000 here, which means you will need at least $30,000 in order to close on a $100,000 home. Now, once you're aware of that, then you can put things in motion and you can start setting money aside and just simply work out a timeline that you think you're going to take to set all that money aside. Then the next step that you're going to do is to work on your credit, particularly on your FICO score. Why is it so important? Well, if you're looking for financing and you have a bad credit score, you won't qualify for any mortgages. No one is going to lend you. Or let's say if you do happen to be fortunate enough to find a lender to give you money in spite of your low credit score, chances are is that that loan, that mortgage is going to be a very high interest mortgage. So a second purpose for having a good credit is getting good rates, right? So having a rate of, let's say, for example, 6.99% versus a rate of 2.99%, it might seem small, but it makes a difference. Over the life of a mortgage, let's say a 30-year mortgage, we're talking about thousands of dollars. We're talking about the 6 digits that you could be saving if you qualify for the best rate possible. So here we are. Now we're gonna move to point number 6, but before we do that, if you're enjoying this episode, do not forget to hit the like button right here so you can help this episode rank and help others like you who are looking for information of this kind. Now, this step is kind of like intertwined with this one, right? So you're gonna get a copy of your credit score, right? Or your credit report, right? But in order to access your credit report, you will go to a website that's called Experian.com. And if you don't know how to access it or what to exactly look for, don't worry. I'm going to leave a link to a video that I created a couple of months ago that's going to help you complement and talk about the subject of Experian. But in the meantime, bear with me. You're going to create an account in Experian.com so you can check your FICO score, you can monitor it. And once you get to that perfect point, to that ideal point that you know you're going to qualify for good rates, you're going to make a copy of that credit report and you're going to go to the bank and start shopping for rates, right? So get credit report and shop for rates. Why do I say shop for rates? Because you don't want to go into a bank and say, hey, I want to see how much money I qualify for, and then have them run your credit. You don't want to do that because you don't buy into the first store that you walk into. You typically want to go to multiple stores and you want to check different products before you find the one. So it's kind of like the same dynamic. You're going to go to multiple banks. You're going to bring them your credit report. You're going to tell them, I just want to see or get an approximation as to how much I can qualify for and what are the rates that you're giving me. I am not asking for a pre-approval letter. Do not run my credit yet. All I need is for you to tell me what is the approximation that I could qualify for. I just need a pre-qualification as to how much. And once you get multiple rates from different banks, then you're gonna find the one, right? And number 7 is selecting the one, selecting the right bank that you want to work with. And that is the bank that you're going to provide all documentation that they require, call it the taxes, copies of your employment letter, copies of your address, driver's license, whatever is it that they request, you give it to them, right? And once you go through the entire qualification process, what they're going to do, they're going to give you something that is called the pre-approval letter. Now, why is this letter so important? It serves multiple purposes. One, it's gonna help your realtor scan you. See, there are a lot of people who want to buy houses, but they're not exactly ready to buy houses. But sometimes these families or these couples or these people, they just wanna go look for houses for fun. They just wanna check it out. And realtors don't like wasting their time. Unless they show up in their open houses, they don't like people calling them up and say, hey, I want to check out this house, and maybe you have no intention of buying. So the first question a professional realtor will ask of you is, hey, do you have a pre-approval letter? If you do have one, then I will show it to you. If you don't have one, I won't bother, right? So that's one. Second, typically, you have a better bargaining power if you do have a pre-approval letter. That means that if the seller sees it, it's going to give you preference in comparison to other offers. Why? Because the seller knows that by you having a pre-approval letter, that means you can close faster than other people who are interested in the house, but maybe they don't even know whether they qualify for the house or not. So that's another reason as to why it is so important to have a pre-approval letter. And once you have all of this readily available, the very last step that you do is to look at houses. Look at houses. I know it sounds surprising, perhaps even confusing, because most people tend to want to look at houses first. But what happens when you look at a house first instead of doing all these other steps that I talked about? Well, there's an emotional component to it, right? You fall in love with the house, you see the pictures, you like the kitchen, you show up, you take a look at it and like, oh my God, I really like this house. But maybe you don't qualify for the house and then you get disappointed. Or maybe you can afford that house, or maybe you do get approved for that house, but it might not be the right house for you because it's too expensive and you might not be able to keep up with the mortgage. That's how you see people foreclosing, because they bought too much house, they bought too much property because they were trying to keep up with the Joneses. And at the end of the day, maybe they just end up foreclosing it because perhaps an unforeseen circumstance happened. People lose their jobs, maybe there was death in the family, and next thing you know, boom, they foreclose, right? So that's why you always start up with your taxes, you start up with your budget, because that will give you the right amount as to how much housing can you truly afford without having to be house poor. That way you can still go out and enjoy some time with your friends, go to the movies, have fun, and then come back to a place that you can call home without feeling that you're throwing your money away. And that doesn't mean anything. And if you don't qualify for a lot of money, that's not the end of the world. You can just continue saving money, or you can just simply buy a smaller house and then save up for another one. Things change, circumstances changes, but what's important here is that you're doing it the right way. And that's by doing the proper budgeting so that you don't wind up in a very difficult situation that you might regret. So that's pretty much all I have for you today. I would love to hear your comments as to what is it that you found extremely helpful, what is it that you would like to implement, or maybe you're somewhere along the lines of getting yourself together for the purchase of a home and maybe this video helped you out. So let me know what you think. I would love to read your comments. And in addition to that, while I still have you here, do not forget to check this episode right here. That's going to help you complement everything you just learned today. And until then, take care. Bye-bye.